Good evening and welcome to another exciting episode of Bond Squad After Hours. Once again, we come to you from the snowy Pocono Mountains, where we had about 3 inches of snow last night, another 3 to 6 inches expected tonight. Finally, we're going to get some warm weather this weekend. We could use it. We've been above freezing actually 4 days since the new year. So never mind about last winter. This winter has been more brutal up here in Northeast PA. But it's been brutal out in the global economy as we're seeing interest rates are at all-time lows. The German 10-year, the German yield curve remains negative out to negative yields out to 7 years. In fact, banks don't know what to do about it. In Europe, we're seeing banks looking to possibly charge negative yields to investors as fees. At least that was one idea brought up by Swedish authorities. Banco Santander, the largest European bank by market cap, says that the models don't know how to price in some of the exotic derivatives. You know, it's a negative interest rate. How do you price that in? The models don't really work. We have GDF Suez, a French company, issued bonds today, and they issued a 2-year note with a 0 coupon. The problem was it wasn't a 0 coupon bond per se. In other words, it wasn't intended to be necessarily a discounted issue like a T-bill or a treasury strip or a corporate zero where it issues at a discount and the difference between the issue price and par is your interest income. It priced just below par for a yield of around 15 basis points. So basically, it was a 0 bond. You were not designed to get any income from it. Why? Because you have negative yields on that part of the French curve, on the 2-year part of the French curve. So a 0 rate is actually a pickup over. It's plus whatever to the French 2-year. You know, if we look at that now, which I can and you can't. I wish I could show it to you, but compliance for some reason doesn't like us to do that. But if I take a quick gander at where French interest rates are, we can actually get that really fast here. And I didn't plan on doing this, but I was just thinking about that as we were coming on the air. So French sovereign curve, we have the 2-year, and this is as of today's close, sitting at about minus 11 base, almost minus 12 basis points. So you got a 0, you're plus 12 to the French 2-year. If you got 15 basis points, you're plus 27. Hey, not a bad deal, right? That's the world we live in, and this is throwing a monkey wrench into modeling, into investment policy, and this goes back to our criticism of models. I was at a Global Interdependence Center conference back in the fall, which discussed modeling. And as always, I speak up. I'm never one to hold my peace. And I commented how the models broke down during the financial crisis, right? And one of my experiences while at Citigroup was walking by one of the mortgage-backed areas and having 2 quants argue back and forth about whether the data coming in on a mortgage bond was correct. And one quant said to the other, and this is not, I'm not making this up, this is impossible. The model says this can't happen. And when I told that story at the GIC conference, everybody laughed except for the modelers. And the problem is the unknowns, the unknown unknown. So the models were never designed to account for a 0 interest rate. If you noticed, I'm wearing, I'll tilt this over, my Suzuki shirt, right? I have this on, 1, because I'm hoping spring is finally here, and 2, many of my closest relationships out there in Bond Squad world know that I like to play with old vehicles. And the past few years, I really got into play with old motorcycles. How old? Well, most of them are not only are they eligible to vote, they could have kids that are eligible to vote. These bikes have carburetors and ignition points. Things have to be manual chokes, analog gauges. Real old stuff. No traction controls like you get on the new touring bikes. And there's something to be said for that, because even if you're using a model or a self-driving car that Apple wants to come out with, you have to know how it functions in case an event happens that confuses the software. And we're seeing that with 0% interest rates. It's confusing the software, it's confusing the models, confusing the formulas. And now experts out there, strategists, modelers, quants, are going to have to use the gray matter between their ears. The problem is we've dumbed the business down to where no one uses their brain. I wrote a little flow chart that I'm going to read off, and this is how it usually goes. Investors, rather than looking at investments and deciding what they need for their retirement, for their future, for their plans, they put off to an advisor. That's actually a smart move for most people. The advisor, which traditionally has been a pretty knowledgeable person, male or female, they were pretty knowledgeable, now puts it off to a portfolio manager. Okay, you can make an argument the portfolio manager knows more about the markets and the economy, where the financial advisor knows more about IRA and 401k regulations and tax consequences. You can make that argument. The portfolio manager now throws it off to a model, a algorithmic driven model. Okay, does anybody there know how to take over the controls manually? What happens on an aircraft, a jetliner, when the autopilot ceases to function? Well, you have a knowledgeable pilot there, takes over the controls, grabs the yoke, has the pedals, has the throttles, and he or she can fly the plane manually. They can fly it without navigational aids. They can even fly it without some of the power assist on some models still. So what we've noticed in the industry is that hands-on ability is seriously lacking. Following the financial crisis, it was determined by people ostensibly smarter than I that what was needed was really just better models. My model's always backward looking. It's not psychic. It can take past events and calculate probabilities, but none of them have factored in a 0% interest rate. So what we have is 0% interest rates. We have a corporation now borrowing at 0%. Essentially, this is completely uncharted territory. So this is throwing the markets into situations where you have inefficiently priced situations, and no one knows really where yields should be. Now we have the ECB announcing or launching its QE program. $1.2 trillion is what the ECB said at the last meeting. Problem is, what's the ECB going to buy? Well, Germany has $1.2 trillion of outstanding debt, but a lot of that's put away and it's negative return out to 7 years. France has about $1.7 trillion, although it has a smaller economy than Germany. But a lot of that's put away too. Remember, these European banks have to hold these treasuries as reserve capital on the balance sheet, so they're not parting with them very easily. And any other holders that can sell it are going to sell it at a negative yield. So whereas the Fed could earn a positive rate of return on the treasuries, the U.S. treasuries that it purchased, albeit low, the ECB will lose money on the bonds that it buys. Yeah, it could buy mortgage-backed securities. That market is really tiny over there. The mortgages that are securitized are usually put into covered bonds, Fondbriefs as they're called, which are corporate bonds issued by banks that is secured by a pool of mortgages. So if they're not passed through, coupon doesn't pass through, but in case that bond would default, the mortgage is back it. If a mortgage in there does no longer meets the criteria, the quality and duration criteria, whatever it might be, average life, it is removed from that pool, that covered pool, and a new mortgage takes its place. But even that market's tiny, and the ECB has said that it believes it has the authority to buy Fondbriefs. Okay, so what does the ECB do? It's probably going to have to buy Italian debt, which, by the way, is the fourth largest issuer of government debt in the world. That's 1.9 trillion, although it has an economy smaller than both France and Germany. But it's a low credit quality, and that's squeezing. But the ECB is probably going to have to buy there, and you're seeing Italian yields compress. The spread between that and Germany get tighter and tighter and tighter. So the ECB is going to have to buy what it amounts to low quality assets to do it. Now, the European economy does have a pulse. We saw some improvements, some in Spain, mostly in Germany. But where are we going with this? We're going to have 1.2 trillion in QE. We have the euro down to 110 versus the dollar, so $1.10 to equal €1. That's a far cry from the 130s that we saw, last summer. Yeah. So that they're getting some benefit from that on the export side. They're getting some benefit from lower fuel prices. That might get them to positive growth. If the European the Eurozone does between 1% and 2% this year, they'll do cartwheels. But it's taking a lot of monetary power, a lot of monetary thrust to travel at low speeds, and it's a structural problem. So that low rates overseas are going to at least provide a pull against long-term U.S. rates. Now, long-term U.S. rates have been trending back up. Remember, they got the 10-year got as low as 166 back in January, and it's trended up to about 214 before dropping to 196. Now, as we speak, a few minutes ago when I looked, in overnight trading, the 10-year is at 211. So the media and financial professionals out there who think they know a little bit about the bond market have been saying, investors, get out of bonds. When the Fed comes in, bond prices are going to get hit. You know what, guys? You're right. Bond prices are going to get hit. But one, you shouldn't buy bonds if you're a retail investor for a total return anyway. That's a fool's game. That's capital preservation and income money. You want to trade bonds, call me and I'll tell you how to trade bonds. And you probably go back to just investing in them. But it's usually the short end of the curve that rises, the yields on the short end of the curve that rises with Fed policy. That's why we get the eventual flattening yield curve. Long-term rates are rising because of inflation pressures. The Fed comes in to address them. All rates rise, but these rates, the long rates, are not rising because of the Fed. They're rising before the Fed comes in. The Fed comes in, eventually arrests inflation pressure, stops them. You get a flat curve and then eventually an inverted curve when the Fed usually overshoots. And it's not that the inverted curve predicts a recession. It's more that the inverted curve is, in a way, the cause of a recession. Why? If you're a bank and you have to borrow at a higher rate on the short end, then you can lend on the long end, or if it's even when you count the spread that a customer has to pay, you're probably not going to do a whole lot of lending. When you don't lend much, that means people aren't borrowing and spending as much. Corporations aren't borrowing and spending for equipment, capital expenditures. So it's that inverted curve that actually causes the recession. It's not a predictor of the recession. It's a chicken and egg thing. Well, trust us, the flattening and inverted curve are the cause. It's the egg. It's the genesis of the economic slowdown and eventual recession. And an economic slowdown, or more correctly, an inflation slowdown, is what central banks try to accomplish. They don't like recessions, but they try to slow things down by raising the short-term rates. So we were of the opinion that short-term rates would rise and the curve would flatten. We are still of that opinion, but something might happen before the curve gets flat. And you can thank the world of sleeve investing, bond funds, pundits out there, and people really don't understand the bond market for this. And we have a precedent that we can refer to that kind of supports our thesis here. We think that there could be, not a definite, it could be a pop in long-term rates when the Fed eventually removes patience from its statement. That can happen as soon as 2 weeks from now, on the 18th, right, when the Fed announces, when the Fed makes its next policy announcement. Why do we think that could happen? because, like we said, investors, advisors, and a lot of these pundits, these rock star managers out there, don't understand the bond market. So they're going to go out there and say, investor, sell your bonds. And what's the investor going to do? Well, since they don't own actual bonds in many cases, and they don't have a reliable fixed income person with whom to speak, they're going to say, just sell what I have, sell my bonds. And these people, the advisors, if they have one, or they'll do it themselves, will sell their bond funds. All right. So what bonds are you selling when you sell a bond fund? You don't know. You're selling your bond fund. What's the fund manager going to do? Fund manager is going to sell whatever bonds he can get, he most easily get a bid on, but he or she has to maintain his or her ratios, right? They can't just sell all their short-term bonds, right? They have a mission statement in most funds. So there starts to be selling pressure on long-term bonds as well. And in the credit markets, the easiest bonds to sell without blowing up the NAVs or keeping that damage to a minimum are the better quality bonds. So what we think is going to happen, we're going to see most of the selling pressure, at least initially, not say most, say much of the selling pressure in long-dated corporate bonds, long-dated treasuries as well. Now, we saw something like this happen in the summer of 2013, right? When the Fed twice, when Mr. Bernanke came out in the Fed statement on May 1st of 13, and during his May Humphrey Hawkins testimony, he alluded to tapering. All right, this spooked the markets, this spooked investors, and they started selling their bond holdings. No distinction, right? They just get me out of my bond funds. What happened after that was trouble in Puerto Rico and Detroit bubbled up. So they said, get me out of my municipal bonds, not sell my Detroit bonds, not sell my Puerto Rico bonds, because most of these people didn't own those bonds directly, although a lot of them did have exposure. So they sold their muni funds. So what happens then? The fund manager can't go ahead, and this is true of an SMA manager if he gets a liquidation. It's easier to, well, SMA manager has to sell everything if he gets a liquidation, right? So he's selling out good bonds as well as bad bonds. They're getting hit, and the price of everything goes down. We were able to pick off some investment-grade 10-year municipal bonds with pre-tax yields around 10% or so. That's pretty attractive. It's pre-tax. Back in the summer of 13, we were able to take advantage of that. There's an advantage to owning the actual bonds. All right. There's an advantage to actually holding the actual security. You don't have to sell it. If you see a dislocation, you don't have to participate in it. But that's not the way things are right now. So we think that we could possibly see the Fed remove patience out of the statement in 2 weeks. 2 weeks from today. That means that a June liftoff for tightening is possible at that point, according to the comments that Ms. Yellen has made. It doesn't mean it's guaranteed, but we think that sets the ball in motion for some more volatility in the bond market. If you have actual bonds and your portfolio is structured intelligently, you could probably hang on to what you have. And if you have some cash, pick up some bargains. This is especially important to investors who are looking for preservation of capital and reliable income. You might be able to, and I can't guarantee it, you might be able to pick up high-quality bonds at yields that are higher than they are today. Right? But you have to do the actual bonds. Okay? And you have to keep suitability and your goals and objectives in mind. That's important. Call us at Bond Squad. Call your financial advisor. Read real fixed income publications. Don't rely on the mass financial media for this. Most of them don't know their rear end from their elbow. All right, and pay attention to what the Fed is saying. You don't have to agree with the Fed, but it's their ball. They make the rules of the game. And this brings us to something that occurred last night. Ms. Yellen was speaking for a group I can't remember the name of it, Citizens Budget Commission. I can't remember. I apologize. But in her speech, inexplicably to many of us, most of us, she comes out and hammers the banking sector. She says she criticizes the culture and practices of bankers. All right, that got us thinking. Why, out of left field, does she mention this now? 5 years, 6 years almost after the financial crisis, blew up. 5.5 years. Why now does she say this? And it got us thinking. What's happening in the next few days? The Fed's going to release, at least within the next week, I believe, the results of the stress tests. Fed officials rarely say things just for the sake of saying them. There's method to their madness. There's a purpose to their comments. And this is especially true of the Fed chair. Fed chair has a lot of responsibility. Everybody around the world pays attention to her, at least everybody in financial circles. So why would you come out and do that? Is it possible she's warning us that the Fed was not happy about some of the practices of some of the large banks that they've stress tested? Remember last year the Fed criticized Citigroup, not picking on them, just using it as an example for some of the practices. It's been whispered around the street that Citi and Bank of America might not be in the Fed's favor at this point. We have no inside information on this, just what we heard on whipping around the street, and that may turn out to be totally false. And we were kind of discounting that. It's just the doomsayers out there trying to create volatility in the bank and finance sector, in the bond market. But by Ms. Yellen saying this last night, is she jawboning? Is she trying to alert the markets that, hey, the Fed's still not happy with the practices in the banking sector? Bond Squad has not been positive on bank stocks for several years. We got a little optimistic back in 2012, and that soon faded. They weren't. It's just the fundamentals aren't there. Dodd-Frank is too strict at this point. Capital requirements are too high to foster, and not only capital, because the Volcker rule trading rules, it just altogether doesn't add up to big profits or big profit growth among the banks. However, from the bond side, this reining in of risk, this pulling in of aggressive practices, and the greater bank balance sheet capitalization makes bank bonds, in our opinion, pretty safe. All right, defaults are less likely than they were possibly at any time in U.S. history. There's so much reserve capital. They may not make as much money as they did before, but the banks, especially the large money center banks and the larger regionals, look to be better capitalized than ever and have a very small chance, at least in comparison to the past, of defaulting on their debt. So that presents potential opportunities out there. So we've been looking at bank and finance bonds, and we still like the big banks, where appropriate. We believe there's opportunity there. For smaller investors, we've been asked by some colleagues, to look at and some readers too, look at other methods, investors who don't have a large amount of capital, but who need capital preservation and interest income, how they could invest in the bond market. Now, our minimum for SMA management is $500,000 usually. Although if we're a Bond Squad subscriber, we'll bend our rules to help out. These people gave us a start. These readers will help them out in any way possible. But once you get inside $500,000, building a diversified portfolio, it becomes more difficult. The smallest you could really stretch it is $100,000. But to do that, you have to get between 10 and 20 names. When you're that narrow, you really have to do your credit homework if you're in the corporate bond market or in the municipal market. You really have to really do your homework because you don't have that diversification. So one alternative that's been mentioned to us, and one reader asked us about it last week, are these defined maturity funds. Guggenheim has it, BlackRock has them, Vanguard has muni ones like this. So we decided to look into them, and they're really not that bad. They unlike target date funds, which your target date for retirement, these instruments are backed by bonds with maturities in and around the maturity date of the fund. Now, they don't guarantee you any set amount at maturity, so it's not like you're buying a bond and you're getting par. You get whatever the bonds are worth at the time, and you're buying the fund wherever it is, and whatever the NAV works out to, it works out to. So the NAV right now is 25, and at maturity it's 23. You get $23 a share, however it might work out. But at least you know when that comes due, and you know when the bonds come due. It takes some duration out of it. So we looked into it, and we looked at the holdings, and we tore apart some high grade and high yield, and a couple muni ones too. And from a bond guy's perspective, we were underwhelmed. Okay, not because they were poorly constructed, but because they have to be all things to everyone. They have to be so diverse, and they have to have bonds from various sectors. So you have to own utilities in there. You have to have industrials. You have to have a little bit of large cap tech, whatever it might be, right? There are bonds in there that are fairly rich. Like we saw one that has Apple bonds in there. Apple bonds are safe as the day is long, all right? They're probably the safest, corporate, or at least among the safest corporations out there from a credit default perspective. But there's no yield. Why not buy a JP Morgan bond and pick up 65, 70 basis points? Is there more risky? Yeah, theoretically more, but we're comfortable with that credit, right? These funds can't do that. So, if you have a small amount to invest, we prefer them over a traditional bond fund, which has no maturity and has unlimited duration. For capital preservation, reliable income, they're better than a total return fund, because a total return fund, and any total return fund manager should tell you this, is that their goal is not interest income or capital preservation. They're trading the bond market, and they're using derivatives and options and whatnot to do it. Short positions, you name it. Even currency plays, within that market. Remember, it's fixed income, currencies, commodities. So they're buying all kinds of linked stuff, and it's not necessarily a bad investment, but it's not to be used for income and capital preservation. So the way we see it, there's still nothing better for income and capital preservation than a bond portfolio. And doing our credit homework, we can, if we had to, structure some fairly small portfolios that should work for many investors. The next best thing would be an ETF with a targeted maturity. You don't want to have all that duration risk. For interest income and cap preservation, we just don't like regular bond mutual funds or open-ended ETFs like that. So that's our order of preference. Let's see what else we have on tonight's thing. Let's talk about China really quick. Right before we went on the air, China announced that it's lowering its growth target from 7.5% to about 7%, and it has now a 3% inflation target. China, we got to give China credit. We bashed China for not becoming Western enough, for lack of a better word. But they learned really fast, actually, because they're doing what corporations do. What corporations do when they know that they're not going to meet previous guidance, they lower the guidance, their earnings guidance. Then when earnings time comes, they beat that downwardly revised guidance. And CNBC and the Wall Street Journal and Barron's say XYZ company beat expectations. They don't mention that the expectations 3 months ago or 2 months ago were lowered, and they beat that lowered expectation. So that's what China is doing now. They know they're not going to. There's unlike we won't say they won't, but say China knows that it's probably not going to grow at 7.5. So we'll lower it to 7. If we hit 7, great. Hit 7.1, 7.2, we look good. If we do hit 7.5, we look like heroes. And that's the official number, by the way. In bond circles, it's generally agreed that China's probably grown below 7 already. They doctor the numbers just like you had on Alibaba. Another company we didn't like has a lot of false sales on there. It's a house of cards. It's Chicago during the 1920s. It has more corruption than Chicago. We apologize to Chicago, because even Chicago during the Al Capone days, wasn't as corrupt as China is right now. And it's funny is that when they crack back on corruption, the growth slowed. So, maybe corruption is good. Who knows? But that's what China's doing. China's it's lowering rates, and it's still probably going to miss previous growth expectations. So in our emerging markets portfolios, which we tend to do, well, we don't do them on an SMA basis. We've done it internally, come up with models at Wealth Strategies and Management. But we try, when we build a model, we try to avoid China as much as we can. We don't like Russia either. We like India, we like Korea, Poland, Mexico, Taiwan, Thailand. We think those are the better EM plays. Not crazy about Brazil. Don't even ask about Argentina. We're crying for them. So, we don't think China is the great driver of the economy as people thought. So that brings us to jobs now. We had ADP jobs today. Disappointed, but not terrible. ADP, Moody's, who does process the data for ADP, acknowledged that oil sector job cuts are filtering into the economy. We saw the Fed beige book today, where everything was still pretty modest to moderate. And the savings at the gasoline pump are translating into household savings and restaurant sales. We predicted that a couple months ago that where you're going to see a lot of the growth is in conveniences and restaurants. Look, you save $50 a week. It's not like you're going to compile that. Most people aren't going to save that for 10 months. Take the $500 and go buy a TV. They're going to get 50 extra bucks, a month, or 100 extra bucks a month, we should say. And they're going to go out to dinner. They're going to go to a movie. They're going to do something fun with it. Besides, they don't. Not sure if it's reliable. If they make plans, they make a big ticket purchase, they factor that into their budget as a permanent or long-term cut to spending, cut to expenses, and then it pops up, and they made a plan to buy a vehicle or another big ticket item. It comes back to bite them. So what we think we'll see here is continued improvement in the job market, but you got to remember where the improvement's coming from. The improvement's largely coming from the very top, which wasn't impaired to begin with, and more so the very bottom. So it's nice that we're seeing wage growth at the bottom end, but it's coming from a lower base. So it's not like in previous recoveries when the guy making $60,000 got a raise to 65 or 70. We have people who are making $8.59 an hour getting a raise to 10, 11, or $12 an hour. It doesn't put them in an affluent class. It takes them, or maybe takes some households off the razor's edge, but that's where it's coming from. So we don't think that this wage growth, even though we think it could be 2.2, average hourly earnings could be in the 2.2 area day after tomorrow. We don't think it's the same 2.2 that you might have seen in recent recoveries. It's from a low base. Even if it's at 3%, it's at such a low base. It has a marginal effect on growth. We have people who are now working restaurant jobs and retailing jobs who made 50, 75, even 100,000 before the housing bubble. And now we're seeing high five-figure and six-figure jobs taken out of the oil sector, and mid-five-figure jobs taken out of the oil sector from the service companies and the manufacturers and the metals and mining companies that provide equipment and supplies to the oil patch. It goes farther than you think, and we predict that would happen as well. And ADP data, or Moody's data for ADP, are bearing that out as well. So what we see happening, we could see a pop in long-term rates temporarily. They get pulled back down. We don't see inflation building, very much anyway. Job growth and wage growth are probably going to continue to be moderate, but sustainable, at least for now. Right now, workers are more affordable than equipment, even with zero rates at this point, especially if you hire them part-time. You avoid medical expenses, healthcare. So that probably continues. It probably continues mainly at the very upper end and the very lower end. So we're thinking 250,000 jobs this week. Could it be 230? Could it be 270? 230, 270 seems a little high. So that's what we're looking at. we could see a pop in the 10-year rate. We could see a break 2.25 if we see some sort of tantrum. But we think the hedge funds and other opportunistic portfolio managers come back in and scoop up bargains. As long as inflation is printing well under 2, and core PCE is 1.3, and as long as the European rates are very low, and they're probably going to be for some time, we don't see long-term U.S. rates really taking a sustained march higher. As we've written several times over the past month and a half, just because rates will probably remain low, they don't have to always remain this low. And we said that when the 10-year was under 2, just for the record. So we could see 2.25, 2.5 temporarily, but we don't think it stays there very long. Gets yanked back down. We don't know if we see it back down to 166 again. That's always possible. And we'll leave you with this. Today, Paul Richards, a strategist at UBS, put out a report, and he mentioned two things that are near and dear to our heart. He said that if you're taking exposure overseas, hedge the currency. We've been big on that. Around the office, we built a model last summer, and just for giggles, and we put 20% of this emerging markets, or foreign model actually it was, in a US dollar bull ETF, USDU. And we did that in June. And people nodded and smiled at the office, and nobody did anything with it. Well, it performed really well because you had the foreign stocks went up and the dollar went up, and you would have captured everything. But so we agree with Paul Richards here. We don't see any weakness in the dollar in the near future. And the other thing he mentioned, and we've written this many times, if you want to see where Europe is going, look at Japan, both good and bad. Stock market, because they're probably good over there because they're going to keep rates low and force people into risk assets and keep exporting strong because of the weak euro. But also we think, and maybe you didn't mean this, but we do, demographics are pointing to a sustained low growth environment, especially if there's no fiscal reforms over there. Their previous welfare state is no longer sustainable when you're moving towards 1-to-1 worker versus benefit recipient ratios. So that's all we have for this week. If you'd like to speak with us about portfolios, hedging, the markets, currencies, whatever you want, just give us a call, 570-424-1555 during market hours. Email me at thomas.byrne@ws, that's Whiskey Sam, the word and, A-N-D, the letter M as Mike.com. That's WSandM.com. And that's all we have for this week. We'll be back next week to discuss the jobs numbers and to maybe give a preview on the Fed meeting. And let's see what the ECB does tomorrow. And with that, have a great night and stay warm. If you're in the Northeast or Mid-Atlantic, drive carefully or stay off the roads. Thanks. Have a great night.